Okay, so let's get started for today. Yes to the person who posted on Reddit. I read Reddit. Now that you've stirred up everything from last term again. And you should probably stop using the F word as much in your paragraph writing. That was the only thing that I noted. The reason I was saying about Reddit is and not that it's going to help you for this year's final, but somebody had posted all sorts of hints on the final exam on Reddit last year. And I just said last class that I thought that was funny because everything they posted was on the final. And I went and looked at it again yesterday, and I scrolled to the bottom and somebody had written, yep, that was exactly what was on the final, thanks for posting this. So, and it wasn't me who posted it, okay? So, because I don't do that. I actually don't post on Reddit. I just read things, because what happened was 2 years ago, there was some gun incident in CCIS, in this building, and we were having our midterm here the next day, and so I started having students emailing me that, oh, I don't feel comfortable writing our midterm in CCIS building because there was a gun incident, and I'm like, I wanted to respond in my terrible sense of humor. The other grading was in ETLC. I'm sure by now they've moved over to ETLC. You'll be fine in CCIS. But that's not really the most appropriate response. So instead I said, I'm sure it's been dealt with, but at that point I realized I better be reading what's on Reddit to see what's going on at the university. So it's come in handy a few times. I'm not saying don't start posting stuff on Reddit, okay? But it's always good to know what people are posting and stuff. I found people dropping classes and things like that. They're like, oh, I'm going to drop a class. If you pay me $50, I'll let you have my spot. Be careful with that in the business department. If a class is really full for like finance or accounting, they lock down the class, which means that if somebody drops, the space doesn't open up. It's kind of rude. So they actually had someone come and complain once to the undergrad department and said, yeah, I lost $20 because I paid somebody, and then when he dropped, I didn't get it. It's actually illegal to pay someone to drop a class for you, okay? So just, definitely don't go and complain about it when it happens to you and it didn't work. But okay, so I want to continue on from last class now that it's 5 minutes. It's okay, I got to catch up with the other class. My class on the other class, the A1 section on Monday. I'm standing teaching, and all of a sudden the whole class goes, and I'm like, what? And I guess a mouse had joined our classroom in behind me, so we had to waste about 3 minutes calming myself down because there was a mouse in the classroom. So they left. They didn't like my lecture, so that was good. But it was a little weird to have the whole class gasp. Okay. Some excitement in accounting class, Okay, so for in class 3.3 that we were doing last class, we didn't get quite to the end because required 2 did state, required 2 said using T accounts post the transactions to the general ledger, but it didn't quite get to the point where I was, adding the accounts up. So let's just do that just to show how you would do that, and we'll do it with the next question as well. Common shares you don't really have to add up because it's already the total. But service revenue, for instance, you would probably add it up just to see what the balance is in the account. I'm just looking for my solution key so I don't have to add. I don't have it, so I'm going to have to add. I know you're going, you should be able to add that in your head, but not up here at the front of the classroom. Accounts receivable, you had a debit transaction and a credit transaction. So you take the $1,450 and you subtract off the $700, and you would get that $750 is the balance. It's a debit balance because the debit side is higher. Okay. And then usually what you do at the bottom is you then add up your accounts to show that your trial balance balances. So we'll take our cash of the $2,900, and I'll do it on the side here so I can sort of flip through. I'm not even going to put titles on it. 2,900 debit, common shares is 3,000 credit, so I'm going to put that as a negative number. Service revenue, 3,250 credit. Office equipment, 4,000 debit. Accounts payable, 3,000 credit. Accounts receivable, 750 debit. Unearned revenue, 900 credit. Salary expense, 2,000 debit. Dividends, 500 debit. And that was it. Now you can put it in 2 columns. We'll do that for the next question. When you put it in 1 column like this, it should add to 0, as long as I've got everything correct. Perfect. Which shows that it balances, which means that at least I posted everything on the debit or credit side. Doesn't mean it's perfect. I could have forgotten to post a journal entry, and so I would have missed both sides. I could have posted it appropriately on the debit or credit side, but put it to the wrong account. Okay? So just because your trial balance balances doesn't mean that everything else in there is correct. You hope it is, but it's not necessarily. Okay? So let's just do a quick poll everywhere question. That was just one person responding, so I wouldn't go by that. I didn't do this one last class, did I? No. Yes? Well, if I did, we'll do it again. You should get it right then, right? See, someone still got it wrong. Every transaction has to affect at least 2 accounts. This one I did, that one as well. Okay, maybe I've done them. Let's try this one. Whoops, I got to turn it on for other things. When a trial balance balances, it is an indication that all journal entries have been posted, the account balances are correct, debits equals credits, or all transactions have been journalized. Okay, the answer is that debits equals credits. Okay, all the rest, you don't know if it's happened. Okay, you don't know if all journal entries have been posted. You could have missed one, which is very common. The account balances are correct. You could have posted to a wrong account. All transactions have been journalized. Again, that's the same thing as all journal entries. Well, it's sort of. It just means that you've maybe missed to do a journal entry in general. Okay. Okay. I need to go like this. Oh, I did that. That's why I had the thing. So, okay. So the accounting cycle. The accounting cycle is, in essence, everything you do during a period of time to account for your transactions. Okay. So usually you're doing it daily, but sometimes there's other things you will do monthly and other items you'll do quarterly. Anytime you're trying to produce financial statements, you're going to need to, in essence, make sure you have everything in there that the company owes or is owed to the company. So this is the transactions kind of in the order you do them. The first step is to analyze those business transactions. Then you're going to do the journal entry for anything that needs to be recorded. Once you've done that, you post it to the general ledger account, which in this course will be like posting to a T account. Then you will prepare your trial balance. Okay? So in essence, that's what we just did for the problem we just finished. Okay? Then at month end or whatever, and when I'm doing these types of things in real life, I have a couple companies that I do their month end reporting for them. I then will look at their adjusting entries, make sure their month end stuff is correct, that I've recorded anything that we haven't paid yet, but that we owe, or where people owe us and we haven't invoiced them, or they haven't paid us, or whatever the case may be. So I'll do what we call adjusting entries, which we will touch on in Chapter 4, but then skip till we revisit Chapter 4 again. You'll prepare an adjusted trial balance, which is the same thing as a trial balance. It's just after you've done adjusting entries. Okay. And you'll probably do steps 5 and 6 about 20 times till you're happy with your adjusted trial balance. Oh, I forgot to do that. Oh, I need to do that. Oh, that account looks really weird. I should see what's going on in there. Okay. Things like, prepaid rent. Maybe you've paid your rent in advance, and so you don't have any rent expense this month, so you need to go and fix that because you paid it in advance of the month. There's other depreciation. Maybe you forgot to record it. Then you'll prepare your financial statements. We have something called journalize and post closing entries, and I'll talk about that a little bit in Chapter 4, but you're not going to have to do that in this course. And then again, you prepare another trial balance just to show that everything did close that was supposed to. So again, that recording process, analyze each transaction. If the transaction needs to be done, enter it in the journal, and then you're going to transfer that journal information to your trial balance, or as I said, in this class, we're going to use T accounts as our ledger accounts. In a computerized system, they don't do T accounts, they will do journal entry stuff. Okay, and so what I just did quickly in the other problem is in essence a trial balance. This one's a little bit more detailed because of course it lists which account and the balance. And this one's done 2 columns, a debit account and a credit account. You can put them all in one column though as well, like I did, and put the credits as negatives. If you have a debit and a credit column, the column should total to the same balance. If you have it in one column, it should go to 0. I've done that one. That's what I thought. Gone ahead here. Okay, so let's look at 3.4. Which will in essence finish off Chapter 3. You had a couple pages to 3.4. I've actually given you journal entry paper for this one, okay, just so we can be neat for the couple of times. And again, I've also done up some T accounts that we can put in there. I do also want to point out that if you have not done your first additional assignment, it is due today. Okay? And if you're like, I have no idea what you're talking about, please go and read the syllabus. As of last night, there were only 440 students who had completed it, and there are 621 in the course. So almost 200 students have not completed it. Okay, in class 3.4, you're all informed now? You're checking with your friend to make sure they did it? You're doing it on your phone right now? No, don't do that. Okay. Okay, 3 focus. The information that follows is for Bobby's Real Estate Agency Corporation. Okay. They got information from October 1st to the 31st. The first required I added in. Review the type of company a real estate agency corporation would be. What type of accounting transactions would you expect? Okay, real estate agency corporation. Usually, one, it's a corporation. So you're going to have shareholders, not owners. Okay, that's what the corporation stands for. A real estate agency is usually some company or business or person who is selling real estate. They don't own the real estate, but they're a broker usually. So they're the ones with their sign outside of people's houses where they're saying for sale and their name and picture are there. Okay? But they don't own that house, they're just selling it on behalf of somebody. So what type of transactions, what do you think would be on their income statement? Just yell it out. Sorry? Commission revenue. They should have commission revenue because that's how they're earning their money.
Sign expense.
Yeah, could have sign expense, yeah. That might be not an inventory, but a balance sheet item, depending, because you can keep reusing those signs. So that might more, I'm not sure what they do. It's not a lot of money, I'm sure, but that might be on their balance sheet instead. Do you think they pay rent for an office space somewhere? Probably some vehicle expenses to drive around to different places. Okay, so they're a service business. You shouldn't see sale of product. There could be employees, absolutely, because they are a corporation. So just when you're doing a business and they're accounting, it's sometimes really good to look at what it is they do for a business, because it helps you identify, you know, if it's a vehicle dealership, they'd be selling cars and trucks. So cars and trucks would be inventory, not necessarily long-term capital assets, property, plant, and equipment. So by knowing what business they're in can sometimes help when you're doing the journal entries as to where they would be posted. Required to prepare journal entries for the above transactions. You may omit explanations. I will always tell you you can omit explanations compared to that one we did last class, that where you had to give the explanation. If an entry is not required, please state no entry. You will see this usually in an exam situation. I think it's actually in one of your assignments coming up. There could be times where there is no entry. And so I don't want you just to leave it blank. Leaving it blank means something to me, which means you don't know what you're doing. So if there's no entry, you actually have to write no entry, so I know that you know that there's no entry. Okay? So prepare journal entries. Whoa. So the first one, issued common shares in exchange for $15,000 cash. So entry number 1. Oh, and sometimes in an exam situation, I've gotten a little better, but sometimes in problems you might miss one of them. Like say you have two things with the same date. Sometimes you might forget to do an entry because you forget the second one. This one all has separate dates. But sometimes it's best to like go 1, 2, 3, 4, and write the number of the journal entry with the transaction so you don't miss one. Okay. So entry number 1 is going to be for October 1st. Issued common shares in exchange for cash. The company is issuing the common shares to its shareholders, and they're receiving cash. So if the company's receiving cash, that will be a debit to cash. And they're, in essence, selling or issuing common shares, so credit common shares. They didn't tell you how many shares. You would never journal entry the number of shares. You're journal entering the dollar value. Number 2, October 2nd. Hired an administrative assistant at an annual salary of $30,000. The assistant will start work on October 5th. Are we paying the assistant? No. Has the assistant started working yet? No. Do you owe them anything? No. There's no signing bonus. It'd be nice to get a signing bonus, eh? We all dream of that, right? I did hear of a student once who got a signing bonus to go to work. And it was an accountant. It was because the firm where they were going to was in the middle of nowhere land. So they were like wanting to make sure they were going to come. So if you decide to work in Nunavut, maybe you could, you know. That's not really nowhere land, but I'm not sure everyone goes, yay, I'm going to go work in Nunavut. This is going to be great, okay? Hopefully I haven't offended someone who's from Nunavut. But you've hired this person, they haven't started work, you don't owe them anything, there's no entry. There's nothing to record in the accounting records. You may have them sign an employment agreement, you may have them sign confidentiality agreements, but nothing gets recorded in the accounting system. The third one on October 5th. Don't worry, I'll probably have offended everybody by the end of the term, so individually, so. And I am trying to be funny. Some people are like, oh, she's so serious and she's so rude. I'm like, no, it's my silly sense of humor. It doesn't work so well. All right, purchase furniture for $3,000, paying $500 cash and the balance on account. Okay, we had something like that last class, right? Where we wrote out the descriptor. So we're purchasing furniture but paying cash, so cash is going out. So we'll credit cash. I always do cash first usually. Makes more sense. Cash is going out, credit cash. And again, you don't have to put it on the second line. You can put it on the first line. Credit cash, if the furniture just cost $500, then we would have debited furniture for $500. It's not furniture expense. It is on the balance sheet. Furniture lasts longer than a year, okay? So you're going to not expense it. The furniture in total costs $3,000. So you're going to need another entry for $2,500 in order to balance. And it said the balance on account, we owe $2,500 still, so therefore that's accounts payable. Number 4, sold a house and lot for $650,000 for Kelly Clarkson. I spelled her name differently. Commission due is $6,500, not paid by Clarkson yet, will be paid October 31st. We sold a house on the 6th of October. Not our house, it's Kelly's house. But we've earned our commission revenue because the sale has gone through. Therefore, we need to record that we've earned the revenue today. She hasn't paid us yet, but in accounting, we don't care about cash per se. We care about, have we earned the money? Have we, in essence, spent the money even though we haven't paid cash? So if you put something on your credit card or on accounts payable, you have to record it because it's something the company owes. You also want to record here that this is something the company is owed. So on October 6th, if they had paid us in cash, okay, because sometimes that's easier for you to do the journal entry. If Kelly had paid us in cash, we would have received the cash. So that would have been debit cash for $6,500. I'm just doing this as an example. There's no cash involved, but there's no negative to writing it down. If we had earned this, we'd earned it because of commission revenue. So the other side would have been commission revenue. Everybody good with that? If we had received the cash from Kelly today, this would have been our journal entry. We did not receive cash today. So cross off the cash, but it helps you put the revenue going the correct way. Instead, it's in essence on account. Kelly hasn't paid us yet, but she owes us on account. So this is accounts receivable. Be very careful when writing accounts receivable that your R does not look like a P, and vice versa, that your P doesn't look like an R when you're doing accounts payable. These are very closely related except for one little line, except they're totally different accounts. If you get this without having to cross off cash, go for it. But right now, most of you are probably just learning this, I believe, okay? And so it gets quite confusing. But if you can learn how cash moves, it makes it a lot easier when doing your journal entries if you just pretend there's cash and then change the account. The 5th one is on October 9th. Received a $250 cash commission for renting an apartment. Okay, so we received some cash. So debit cash for $250. And we will credit commission revenue. Okay, you don't have to call it commission revenue. You could just call it revenue. You could call it service revenue. I'd even take sales, even though it's not really sales. Okay. Number 6, on October 15th, paid $700 for advertising costs relating to the first half of October. Okay, so we paid $700 for advertising costs. The reason I've added in for the costs relating to the first half of October is so that you know we've already consumed those advertising costs. Sorry, question. Oh, I've got 2 of you. Sorry, I was pointing at the girl first. Yep. Number 1, unearned revenue is a liability account, okay? And that's when you haven't earned it yet. So if this one, for instance, received cash as a deposit for providing commission services, then you could put debit cash, credit unearned revenue. But we've earned the revenue in number 4 and in number 5, so it has to go to revenue. Accounts receivable, you might think accrued revenue. Accrued revenue you could use. And I answered that one on discussion board already, but I would just use accounts receivable. Where was the second question? For which one? Number 4 again? Number 5. What do you want it to be? But they're receiving a commission for renting. So not only do they sell properties, they help find people to rent apartments. So it's not the landlord. It was received a $250 cash commission for renting the apartment. Doesn't happen a lot, but sometimes no one's ever had to pay a commission when renting here in Edmonton, do they? I would think in like New York or something, you hire a broker to help you find an apartment, or in like a city where you want a certain thing. So in essence, you've hired a broker to help you find something instead of going through the ads yourself. And you would have to pay them something. Good? Okay. October 15th, paid $700 for advertising costs. So the reason I said the first half of October is because I want you to understand we've consumed it. Most companies that you pay for advertising with will charge you up front, because once the advertising is run, a lot of times you won't pay them. So you have to pay them ahead of time. It's like rent. You have to pay it on the first day of the month, because their thing is you're not going to be living there if you don't pay me. Okay? And that's why they like the security deposit. So the reason I've said for the first half of October is so that you know it relates to the current month. If this was advertising costs relating to the last half of October or for November, this would not be an expense. And we'll get into it next chapter. It would be a prepaid expense and would be on the balance sheet because you haven't consumed it yet. So in this scenario, we're paying for something, so cash is going out. Again, you're assuming it's cash, okay? That's the currency, okay, that we're going to use. If they're using cryptocurrency, they'll let you know. It is for advertising. It is for advertising consumed, so it's advertising expense for $700. Number 7, October 24th, paid the amount owing for the furniture purchased on October 5th. Oh, okay, well on October 5th, that's this one up here, we had recorded that we still owed $2,500. So that's what they're saying we're paying, the $2,500. So credit cash for $2,500 because we're paying it. Cash is going out. We've already set it up as payable. We don't want to add more furniture. The furniture is already recorded as $3,000. So we are going to debit the accounts payable because we set it up as a payable previously. We no longer owe it. So therefore, we need to bring that payable to 0. Number 8, October 30th. Paid the administrative assistant $2,500 salary for October. Okay, so we're paying a salary, we're paying them in cash. So credit cash, because cash is going out. $2,500 again, it's two things for $2,500. We're paying a salary, so salary expense. Wages expense, wages and benefits. It's an income statement account, and it is an expense. Last but not least, received cash of $6,500 from Kelly Clarkson owed from October 6th. Okay, so if we go back here to October 6th, remember we recorded here debit accounts receivable, credit commission revenue, because we earned the money, we just hadn't been paid yet. So now we are being paid, so we will debit cash because we're receiving cash of $6,500. And we're going to credit accounts receivable because Kelly no longer owes us this money. You don't want to record it as commission revenue again because you haven't earned it twice. You've already set it up as commission revenue. Required 3 says post these journal entries to T accounts. Okay, so I'm going to use my scribble from prior years because I want to be able to post them without flipping back and forth 24/7. So we're going to do exactly what we did in last class. Cash, common shares. We are debiting cash for $15,000. We are crediting common shares for $15,000. Journal entry 2 had no entry, so we don't have to do anything with it. Journal entry 3 was debit furniture. And again, I don't care what order you put these in, for $3,000. Credit cash for $500. Credit accounts payable for $2,500. Accounts receivable, debit for $6,500 for journal entry number 4. Credit commission revenue for $6,500. Number 5, debit cash for $250. Credit commission revenue, we already have that one for $250. Advertising expense. Number 6, debit advertising expense for $700. Credit cash for $700. Number 7, debit accounts payable for $2,500. And credit cash for $2,500. Don't confuse that with number 8, which is also $2,500 in credit to cash. And debit to salaries for $2,500. Then we had debit cash for $6,500. Number 9. And that was credit accounts receivable for $6,500. And that was it. Okay, and then it said to prepare a trial balance as at October 31st. So we need to sum these up. And you should get $15,550 for cash. Accounts payable went to 0. I don't care which side you put your 0 on. I usually put it on the side that the account is regularly. So accounts payable, normal balance credit. Accounts receivable, normal balance debit. But it doesn't matter where your 0 goes. $67.50. What's that? No. Why do I think I need this other page? Maybe I'm giving you extra paper. Okay, so now we've got all that, so we prepare the trial balance. I'm going to put the accounts and everything. I'm not going to, what should I do? Usually a trial balance is prepared in the same order as kind of your balance sheet and then income statement type items. Usually in liquidity order is usually how it is. Doesn't matter, okay, for purposes of this course. Okay? But sometimes when you're going from the trial balance to the balance sheet and income statement, it's good to have everything in one spot. And if you're writing them off the computer, you'll put them in spots that work, okay? I'm just going to do them in order that they're here. So cash, and I'm going to do 2 columns this time, the debit column and the credit column. You can do it the way I did last question, or you can do it this way. Cash, $15,550. Okay. The next account we have up there is furniture, $3,000. No, we don't. The next account we have up here is common shares, and then furniture. Common shares, credit for $15,000. Then we have furniture for $3,000. Then we have accounts payable for 0. You don't even have to list it if you don't wish, because it's 0. Then we had accounts receivable for 0. Again, you don't have to list it because it's 0. Then we had commission revenue for $6,750. Then we had advertising expense. That was $700. And then we had salary expense for $2,500. Okay, and if you add them up, don't forget to include cash in the top there. You'll have $21,750 in the debit column and $21,750 in the credit column. All right? And then from there, you can prepare your income statement and balance sheet and items like that, but we're not going to do that probably again in this course because we did it in Chapter 2 already. Good? Sort of? You guys are like, no, totally lost. All right. I'm just going to start into Chapter 4. We are just lightly touching on Chapter 4 in this class right now. Someone asked me the other day about Chapter 4 on discussion board. And I'm like, if you look at your syllabus, we start Chapter 4 now, or they emailed me. And I said, and then Later, like week 26, we revisit chapter 4. So be careful when doing your recommended questions, because any topic we revisit, sometimes you're using the online stuff, I threw the questions, the solutions all in the one area. Okay. I want to introduce this though, because I want you to understand, just like I was talking about, that you need to record things when you earn them or when you have in essence incurred the expense, even if you haven't paid for it. And we call that accrual accounting instead of cash accounting. So companies do need to have immediate feedback on how well they're doing. So accounting divides your economic life of your business into periods of time, monthly, quarterly, annually. Usually the longest you'll see a financial statement for is a year. Many transactions though, even if you see something for a month, many transactions affect more than 1 month. A bunch of you probably pay car insurance, and some of you may have to pay it for 6 months at a time. Is anyone in that situation have to pay 6 months at a time instead of month to month? A few of you. Okay, good. I thought there was. Or you have to pay first month's rent, okay, first and last sometimes, and a security deposit. But it doesn't all relate to now. So you want to have that when you're recording something, you want to record it in the proper period of time. So when we talk about revenue recognition, you want revenue to be recognized when your sales effort has been performed. The amount that you know you're going to be paid is determined, and that you're going to get paid eventually. Sometimes companies will go and incur sales because they want to get rid of their product and show that they're making money, but they're not always guaranteed they're going to get paid because they're selling it to people who are willing to take the stuff, not necessarily people that want the stuff. And sometimes you're selling it with the idea that they can return it as well. So a merchandising company is a company that sells a product, so usually they earn their revenue when the merchandise is sold. So Walmart, you go, you buy a product, when you pay for it at the till and walk out, that's when they would recognize their revenue, whether you paid credit card or cash or whatever the case may be. If you're a service company, it's going to be considered earned when you provide the service. Okay? Doesn't matter when you invoice the customer, it's when you've provided the service. You may say, I'm just going to invoice people every 3 months. We actually earned that every month, so you're going to need to put into your accounting records the amount you earned every month, even though you haven't even invoiced them. And that's where that accrued revenue comes into play. Accrued revenue is usually set up when you haven't done a physical invoice. It's pretty much the same account, it's just you haven't sent out the invoice yet. Expenses need to be recognized when you've in essence incurred the expense, okay? A lot of times you will record the expense in the same time you've earned the revenue, okay? But if you've incurred the expense now but you haven't paid for it, it needs to be recorded. If instead you were doing the cash basis of accounting, revenue is recorded only when you receive cash. Expenses are only recorded when you pay for them. So you can have misleading financial statements, as people may sit back and go, ooh, I'm not going to pay for that yet, so it's not going to show up on my income statement. We will not be doing the cash basis of accounting in this course. Every term I get one student who's like, oh, the reason I didn't accrue that was because I assumed we were using the cash basis of accounting. No. There is no cash basis of accounting in this course, unless I specifically say it, which I don't see happening. Okay? Otherwise, if you have to record something when it's in essence been incurred, or you owe the money, or someone owes you the money. So revenue is recorded when earned, rather than when cash is received, and expenses are recorded when incurred, rather than when cash is paid. Again, this is the accounting cycle I already talked about in today's class. Now, adjusting entries. We just did a bunch of entries that usually are based on cash, or an invoice has been sent out, or we've earned the money. Adjusting entries, sorry, this is poking into me. Adjusting entries are usually something where there's not necessarily an invoice that's gone, or you haven't received the bill yet necessarily. Definitely haven't paid it. So adjusting entries are made to adjust or update your accounts at the end of an accounting period. They are required because a lot of times the trial balance doesn't have stuff if you haven't seen the piece of paper come across your desk or that source document. Some items don't get recorded daily, some costs are not recorded during an accounting period, and some items are maybe unrecorded, so you need to go and record them. But this is what makes this chapter difficult, is you're usually recording things that are a little bit more, you have to think of them to do them. You have a loan, and you pay your interest next week, but month end is right now. You should be recording in your records that you owe some interest, even though you haven't paid it yet. Okay? Because as of today, you do owe it. You just don't have the bill yet. And so it makes it a little bit more complicated because it requires you to put things in the accounting system when cash isn't involved at all. So we have two types of items we prepay for, prepaid expenses, or where someone's paid us in advance, which is your unearned revenue. Or your accruals, we're going to accrue revenue, or we're going to accrue expenses. So something that's a prepayment, cash has been recorded. Because when someone gives you the money or you give someone else the money, cash has been recorded. But you've put it on the balance sheet because it's either a prepaid expense, like the security deposit on your rental location, or it's unearned revenue, like you've sold someone a gift card. And the reason you're going to have to deal with them is you have to look at month end and say, okay, how much of the gift cards have been used? Or how much of the prepaid expenses have been used? And you're going to have to move it to the income statement appropriately. Accruals do not have cash affected yet. You haven't received the cash, you haven't paid the cash, but revenue has been earned and expenses have been incurred. So once you do all these entries, you will prepare this adjusted trial balance, which again is the same thing as a trial balance, it's just with the updated numbers. Okay, I'm going to stop there for today because you're all starting to get antsy. No class on Friday because you have your quiz. Okay? And hopefully you got the email.